You're listening to Capital Topics, episode number 66. This is a monthly podcast about passive asset management and financial and tax planning ideas for the long-term investor. Your hosts for this podcast are James Parkyn and me, François, Doyon, Rochelle, both portfolio managers with PWL Capital. Our topic for today will be the review of the performance of capital markets for the first half of 2024. Enjoy! Good morning, James. How are you today?
Good morning to you, François. I'm very good, thank you. How's your summer been so far?
Very good, very good. Before we start, we thought of rewarding our regular listeners with a prize. All of you are eligible. We will have more details at the end of the podcast on that. Now, that being said, I will start to cover today's topics with which is the mid-year review of global capital markets performance for the first half of 2024. Our regular listeners know that we cover this topic twice a year to help them better understand and evaluate their portfolio's performances.
Okay, François, since we're going to cover a lot of data points from our market statistics report, I think we should remind our listeners that this report can be found on our Capital Topics website page in the resources section, or alternatively, they can find it on our team's page on the PWL Capital website.
Yeah, indeed, James. And I would add for listeners that they can also find the performances of our model portfolio on the Capital Topics website, and again, in the resources section, or directly on the team's page on the PWL Capital website. Now, let's move on to our topic. If you have listened to our podcast number 65 on how to invest when markets are making new all-time highs, you know by now that 2024 is off to a great start.
Absolutely, François. It's been a great first half this year. This follows strong market returns in 2023, and you'll recall, especially in the U.S. market, and in 2023, the last 2 months were incredible. The S&P 500 was up 15.8% in U.S. dollars. That's just enormous. So it's been quite a run.
Yeah, those were pretty strong results. And these strong results came despite a load of economic and geopolitical uncertainties. On the economic front, stubborn inflation above central banks' comfort level meant that interest rates would stay higher for longer, and that these prolonged periods of higher rates would eventually negatively impact economic activity. Market pundits were speculating and are speculating around the prospect of a soft landing or even a recession.
Well, François, I would add that despite these fears, gross domestic product growth rates are still positive in Canada and the Euro area and the UK, and somewhat stronger in the US, though it's slowed down recently. On the geopolitical front, uncertainties continue. Russia is still at war with Ukraine, sadly. Israel's conflict with Palestine is tragic and ongoing. And, we are also seeing more and more geopolitical fragmentation with a resurgence in the competition amongst rival superpowers. Again, China and the U.S. Are really, behind the scenes going at each other. On top of that, there's been major elections with major global powers, like in the UK, changing government, France, polarized election, Taiwan, and India, of course. But finally, closer to home, everybody knows we can't escape it. The media onslaught of the news around the U.S. election and the incredible, turn of events with, that we all know about. So, and, the two sides are clearly very, very entrenched and polarized in their positions. So again, the outcome in that election is still quite uncertain.
Indeed. And James, as always, there's plenty to worry about. But as the popular saying goes on Wall Street, the bull markets have climbed a wall of worry. This being said, there's still some good news on the economic front. Inflation rates have declined worldwide, enabling some central banks to start cutting interest rates. Here in Canada, the inflation rate has declined from 3.4% in December 2023 to 2.7% in June. And recently, the Bank of Canada cuts its central bank rate from 4.75 for 4.75 to 4.5. In the US, the inflation rate has also declined from 3.4% to 3%, but the Federal Reserve has yet to cut its target rate. It remains currently at 5.5%.
Well, I would add, Francois, to that on the inflation front in the U.S., it appears that the Federal Reserve is now much closer to cutting interest rates.
Mm-hmm.
Their inflation news is much better, uh, getting very close to the targets that central banks want to see. Expectations, though, earlier this year was that the Fed would be cutting rates several times. And in the last Fed Reserve meeting, what they signaled was only one rate cut would happen.
Right.
So, again, globally, inflation news has been getting better, and inflation appears under control, dropping from 2.9 to 2.5% in the euro area and from 4 to 2% in the UK. The drop in inflation in the euro area prompted the European Central Bank to cut rates from 4 to 3.75%.
Yeah, I think, James, that it's fair to say that inflation rates are under control and that rates are close to the central bank's target of 2%. We can also add that the central banks have moved from a globally coordinated effort to fight inflation by swiftly hiking rates to a phase of rate cuts that will be more sporadic and intermittent, reflecting each domestic economic situations.
I think you're absolutely right, François. I'm not an economist, but I think central banks are really going to adjust their interest rates downward based on their respective domestic economic realities that are continually evolving. But again, I think the central banks so far, they've really done a great job bringing inflation down.
Indeed. Okay, so now let's look at market statistics for the first half of 2024. Again, as a reminder, a market stats page can be found on our Capital Topics website and in the team section on the PWL Capital website. We'll provide a link with the market stats page with the podcast. Starting with fixed income, the yields in Canada and in the US remain well above the average of yields available in the last 20 years. In Canada, the yield on the 10-year Government of Canada bond was on June 30th at 3.5%, which is 100 basis points above the 20-year average of 2.5. In the US, the yield on the 10-year Treasury note on June 30th was roughly 4.4%, which is 140 basis points above the 20-year average of 3%.
Wow. Well, that's seeing Canadian rates trade through to like that. It sort of explains why the Canadian dollar is weak relative to the U.S. currency. But since yields, François, are above multi-decade averages and inflation is getting back to normal, I think now could be a good time to reflect on your bond allocation. I'm saying this because when rates were low, a lot of investors increased their exposure to risky assets or just weren't getting any return on their bond allocation.
Mm-hmm.
But now that these rates have sort of, as we've called them in our prior podcast, normalized, but also at the same time, equities have done really, really well. And so it could be a good time to de-risk your portfolio. And I'm proposing this, François, not as a tactical move or short-term move, but really as a long-term strategic portfolio decision.
Yeah, I in simple terms, James, I think you're trying to say that this advice is not market timing. To be more precise, I believe, James, what you're proposing is that investors should do a review of their risk capacity and take advantage of much better interest rates as they de-risk their portfolio.
Correct, François. It's really good that you point that out. So it's really, especially considering the extraordinary performance delivered by the stock markets in September 2022, I think investors should ask themselves a simple question. How would they react if there was a serious bear market? And that can't be predicted. We all know that. We can't predict the future. But if you can stay the course, then maybe there's no reason to change. But if you feel that you need to have a safe bucket that's larger, now could be the time to implement that.
Right. Okay, so coming back to the performance of bonds, Canadian short-term bonds were up 1.6% as of June 30th, and the total bond market, which holds longer dated maturity, was down by 0.4% due to a slight increase in the yields of longer dated bonds. You need to remember that bond yields and bond prices move in opposite directions. For the last year, Canadian short-term bonds have also outperformed longer dated bonds with a performance of 5.6% compared to 3.7% for the total bond market.
Well, François, I think we should highlight that investors have lost money on their bonds over the last 5 years. So let's not just look at the current year's bond returns, but really the last 5 years. And from our market statistics page, you can see the impact of that historical, statistical black swan year like 2022 when the bond index was down over 11%. The Canadian total bond market returned over this 5-year period a negative 0.05%. And that's before inflation. When you factor in inflation averaging at 3.4% over that period, investors in bonds, that component of your portfolio is really lost a significant value.
In real returns, yeah. Correct, James. But again, these returns are for the Canadian total bond market, which hold longer dated bonds. For investors like us who use a short-term bond with maturities of 1 to 5 years, the annual performance over the last 5 years was an annual 1.4%.
Okay, so François, that's we've covered the bond market, I think, pretty thoroughly. What happened in the equity markets?
Well, looking at equity markets around the globe, all main indices we followed have had strong positive returns in the first half of the year.
Yeah, well, I would add to that, François, that not only have they had very strong returns, but many of these global indices are making new all-time highs. Again, looking at the U.S. with the the S&P 500, which is really the large cap stocks. This index has made an incredible 31 new all-time highs in the first half of this year. So other global markets like the S&P TSX Composite Index here in Canada and the MSCI EAFE Index for developed markets outside Canada and the U.S., they've reached new all-time highs as well this year.
Yeah, correct. But the only main index we follow that has not made new all-time highs this year is the MSCI Emerging Markets Index.
Yeah, so when we drill down and try and get more granular on what's happening there, really it's the story is the poor performance of Chinese equities over the last 3 years or so. Chinese equities still currently represent about 25% of the MSCI Emerging Market Index, and their poor performance is really weighed down on this index. I'd highlight that incredibly, Chinese equities are down close to 42% from their all-time high a few years ago.
Yeah. So now getting back to Canadian equities, the S&P TSX Composite was up 6.1% in the first half. Large and mid-cap growth stocks led the way with a performance of 7.4% compared to 4.7% for large and mid-cap value stocks. Small-cap stocks outperformed large and mid-cap stocks for the period with a performance of 9.3%, which is very nice. For the last year, the S&P TSX Composite had a total return of 12.1%, which is considerably higher than the long-term expected return.
Well, François, what about U.S. equities?
Well, Jamie, U.S. equities were on a tear in the first half of the year. The S&P 500 index had its 13th best yearly start since 1950. And as you mentioned, it reached multiple new highs. Looking at the details, the U.S. Total Market Index, which includes mid and small cap stocks, has had a strong performance of 13.6% in U.S. dollars and of 17.2% in Canadian dollar. The difference in performance is due to the Canadian dollar losing ground versus the greenback for the period. If you've been following the headlines, you will not be surprised to hear that large and mid-cap growth stocks had an extraordinary performance as of June 30th of 24.6%, that's in Canadian dollars, compared to 10.1% for large and mid-cap value stocks. Small cap stocks, however, underperformed their larger counterparts with a performance of 5.1%. Over the last 12 months, the US Total Market Index had a performance in Canadian dollar of 24.2%.
Well, I would add to that, Francois, and again, many of our regular listeners know this. The strong performance has really been driven by stocks that the markets perceive have a strong component of artificial intelligence, and this is primarily big tech stocks. But
Mhm.
again, it includes others that aren't tech stocks. According to Morningstar, roughly 62% of the return the first half of this year was due to seven stocks: Alphabet, Amazon, Apple, Microsoft, Meta, Nvidia, and Broadcom. And again, most of these are tech stocks, but Amazon and Alphabet and Meta are not considered as part of the tech index. But again, this is 62% of the returns due
Yeah.
to those
Yeah.
stocks.
Yeah, and that was a story in 2023 pretty much. But at the beginning of this year, there was hope that the rally would broaden up beyond large cap technology stocks, but it appears it hasn't yet. This being said, James, when you look at our market statistics page, you will notice that large and mid cap value stocks have still been delivering very decent returns. Their performance may appear lackluster compared to growth stocks, but over the last year, they still returned 16.8%. That's in Canadian dollars. And over the last decade, almost 11% annually. These are very, very good returns. They only appear weak when compared to the outsized performance of large and mid cap growth stocks, which returned 37.8% in the last year and 19.3% annually over the last decade, which is huge.
I again, so it's very important that you highlight that those returns are great, but nothing matches the large growth. So again, when we
Mm-hmm.
look at PWL estimates for long-term expected returns, the recent performance of large and mid-cap stocks are way off the charts. We have to wonder how long this outperformance will persist. And the noise, again, if you want to follow the noise of the financial media, from market analysts, they're saying, valuations are stretched and they're vulnerable to major corrections, but nobody can predict market corrections or
Yeah, we
when the
can't predict.
psychology is going to turn.
Can't predict, but just looking at the numbers, say their outsized performance there in the large and mid cap growth stocks. So finally, looking at international developed equities, large and mid cap stocks, as we mentioned, were also up year to date. They were up 11.1% in local currency. In Canadian dollar, international developed equities were up 8.8% since the Canadian dollar appreciated against the basket of currencies included in the MSCI EFI. Here again, large and mid-cap growth stocks have outperformed value stocks, but by a smaller margin with a performance of 9.7%. That's in Canadian dollars compared to 7.9% for large and mid-cap value stocks. Small cap stocks are, however, trailing their large and mid-cap counterparts with a performance of 3.8%. To conclude, emerging market stocks are also performing well with a year-to-date performance of 11.2%, and similarly to developed markets, value and small cap stocks are trailing growth and large cap stocks.
Well, it's pretty clear to me, Francois. Investors, based on these market statistics, need to review their exposure to large and mid-cap growth stocks in the U.S. That being said, I would recommend our listeners to be very wary of one of the most common cognitive errors that investors make, which is being influenced by recency bias. Again, just to remind our listeners, this is the tendency to put too much emphasis on recent performance trends, again, which lead investors to deviate from their long-term investment plan. Therefore, please keep this in mind when reviewing your portfolios.
I totally agree, James. Market trends change over time. For the last years, U.S. growth stocks have outperformed, but it will not always be the case. Investors need to stay diversified globally and have exposure to academically proven market premiums such as small cap and value stocks, because you never know when the tide will turn. So thank you, James, for sharing your expertise and your knowledge today.
My pleasure, François.
So before I conclude this episode, as promised, we have a surprise for our listeners. We have tickets for the Omnium National Bank Tennis Tournament in Montreal that we would like to give away. The tickets are available for the qualifying session on Monday, August 5th, starting at 11 a.m. So if you're interested, please email us at capitaltopics@pwlcapital.com. It's first come, first serve, so hurry fast. We have 4 pair of tickets with parking passes to give away. It's a great event. If you've never been, it's very fun to go. That being said, now that's it for episode number 66 of Capital Topics. Don't forget, if you'd like to submit questions or suggestions for the show, please email us at capitaltopics@pwlcapital.com. Also, if you like our podcast, please share it with your family and friends. And if you have not subscribed to it, please do. Again, thank you for tuning in. And please join us for our next episode to be released on September 25th, as we will be taking a break for the summer holidays. In the meantime, make sure to consult the Capital Topics website for our latest vlogs. See you soon!